Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description.
This is from last week, and hopefully it'll make a little bit of sense, at least from a standpoint of where we're at. So I literally wrote gold is a new VIX, right? Last Thursday. And a lot of this focus, by the way, is dancing to default, which is another way of saying sovereign default in repayment of their debts. That's the focus of this. It's not like US can really default, we can print money, but we can default on repayment of debts. So the gist of it was Trump and Bessent have trailed, yada, yada, yada. Bond volatility is a really big risk, yada, yada, yada. Gold is up 19% as US dollar continues to crash lower. Risk of US yields continuing to rise with gold as dollar falls is a sure sign that they are losing control. So these are the macro reasons that underpin the gold advance. You've already heard me explain why Jeffrey is long the miners, but this is also something that is a trend trade that started last year. Moving to the exits, as funds move to the exits, gold becomes the new VIX. Okay, so then I go on. The point I wanted to make was this. As fiscal credibility is eroding, this is something I wrote for clients because this is what I see, markets are starting to price in a higher cost that the US might default or debase its debt. Here are the things I'm tracking for signs of its progress. Okay, the 10-year treasury yield rises even as risk assets sell off. And this is a dance. So just kind of keep in mind, we had a massive move higher last week, which is what caused Trump and Bessent to step in on April 9th and imply that they were going to pull back tariffs on Apple and chips. But in reality, they just said, nah, we're just going to give them 1 to 2 months. Anyway, the point is, we absolutely had a spike higher in yields, which was very, very damaging to US credit, sovereign bond holders, equity holders, the whole thing. So anyway, moving on. Credit spreads have already widened, but this is definitely something that will continue. Term premium rises strongly. Bear steepening of the yield curve threatens, which by the way, whoosh, the 10 and 20, the 10-year, 2-year yield curve is up. It hit like 66 basis points, but it's hovering in the 50 range. That's really strong. Fed talk of cutting, they have not yet, and Powell confirmed that, although you can always get them to bend the knee one way or the other in time. But even if they do talk of cutting, long end yields don't fall, or potentially they even rise. We get some auction tails, which hasn't happened yet. These are big picture. Okay, so we're not just talking right now, but I'm getting to the gold part. Inflation break-evens rise with yields. That's happening. The dollar falls with yields rising. That's happening. And gold and yields rise together in a nutshell. So this is a massive, massive macro trade. And it's not just, central banks hoarding, China in particular, and all the other reasons. There's a really, really big reason why gold is spiking higher and why yields can move higher as well. So anyway, that's a write-up that kind of hopefully explains a little bit of why I don't recommend gold short. Absolutely not. Can I see profit taking? Yes, but I don't want to short gold.
Yeah, and that's, I think you can kind of sense behind the scenes. We saw one of the biggest sort of rate jumps in volatility that we've seen in a long time last week. And so I think, part and parcel of all the things that you're saying, under the hood, we have some bad things happening, right? And I think that's what we need to be prepared for. And I think it's almost a straddle-ish kind of market where I think at any moment, we've had full evidence of this. Last week, we got a couple, over the last couple of weeks, we've gotten 2 examples of if Trump says the right thing, or even half the right thing, this market can rally like a scalded cat. I mean, it will run 5, 7, 8, 10%. The shorts will scramble. But the equally so, I think that these fundamentals and the underpinning of this market is very, very weak. It's very thin. And so we could just continue to go down. So it's a difficult market to trade because at any moment you can get caught short something and you're just going to get trampled.
And look at this. This is not just us talking about recession risk and, recession. We're talking every Wednesday. Recession risk at the beginning of the year. Recession risk odds rising. They went from 25 to 30 to 50 to 60%. BlackRock, the largest asset manager in the world, announced today on a Jack Farley episode, economy is in recession now. Their clients are going to hear that. So
that's right. And people are getting their statements and going, wait a minute. I mean, last August was nothing. By the time you got your statement, no problem, right? This is a real problem.
That's true. It was a V-shape.
Yeah, that was a V-shape. That was like a blink. You blinked and it was over. Now, and I think people don't get lulled into a sense that, okay, the VIX coming from 55 to 30 means things are okay. We had an ATR, an average true range range that was double,
Yeah.
higher than COVID. It was double what we saw in August and higher than COVID. I mean, we priced in kind of something breaking is really what happened around 4,800. And thank goodness we got that sort of bond put rally. But there's no question VIX 30 VIX 30 might be the new 20s because of everything going on if we truly are in a difficult.
It will be a little bit of a dance, but for right now, we definitely have no Powell capitulation.
Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description. Watch the full Options Macro to Micro Power Hour episode by clicking on the video here and subscribe to LaDucTrading YouTube channel for more content.